All right, welcome everyone to the April 2026, hard to believe it's April 2026 edition of Clear Vista Financial Perspectives, our monthly market update that we do for clients and people that are just interested in how the markets and the economy are going. And with everything going on in the world today, it's easy to feel a little unsettled when it comes to the markets and the economy. So my hope today is that we'll have a few things to say that might help put your mind at ease. We'll walk through what it all means for you, your investments, and your financial plan, and quite frankly, your peace of mind. So today, we'll give a little bit of a market recap, an economic update, and how this impacts everything with what you're thinking about. So we'll discuss these usual things. If you want to send in a text question to us, we will try to answer those live on the program today. You can send those to 254-282-0495. That's 254-282-0495. Or if you think of one later on, you can actually email us at info@clearvistafinancial.com, and we'll try to get back to you within 24 hours. So a lot has been going on this week. We still got the Iran war, and the last night the president gave an update on the status of the war and what his thoughts were. It was interesting because there's a lot of things. What I usually do whenever there's a big political speech is I'll listen to one channel for the speech, and then I'll go toggle back and forth between conservative and more liberal news channels to see what people are saying. And last night I convinced one of my teenagers to sit down with me and listen to the president's speech. And it was interesting his take on things. First and foremost, he said that, that guy seems to like to brag a lot about his accomplishments. And I said, yeah, you're right. He does. What else did you hear in that? And so we had a conversation about what that meant and how indeterminate the president made the end of this conflict or war seem. So we're going to talk a little bit about that today. And the markets initially reacted this morning to the negative, the downside, down 2% at one point, and but now is kind of leveled off and just barely negative as we're recording this and doing this live broadcast here today. If you are in a situation where you've been following the markets, you know that we've had a lot of volatility. These are the major indices that we track and so forth. It's not necessarily your portfolio if you're a client of ours. Our clients did not experience, if you're a modern investor, did not do as poorly as the indexes did. But the S&P was down 5.1%, and that's only because we had a great day on March 31st. So it was a very volatile time, and it's to be expected. Normally, this time of year, we see a lot of volatility, but of course, the Iran conflict causes a lot more unsettledness in the markets. Sorry to stutter there. So the Nasdaq was down 4.8%. Russell 2000 down 5.1% for the month. Long-term treasuries even should be known as a safe haven. They were down 4.76% for the month. I'll explain why that happened in just a moment. And then a moderate index that we look to kind of track our performance when different places was down 3.6%. So really, March has been the bellwether month for determining the performance year to date. S&P is down 4.6% year to date. The Nasdaq is down minus 7.1%, but that's been declining since the end of October, not necessarily what's happening since the Iran conflict war started. Small caps, the Russell 2000, it is actually positive for the year, just slightly. Long-term treasuries are barely negative for the year, so March was a very significant decline for those. And then the moderate index is just barely off as well, about 0.75% year to date. If you remember the ABC sportscaster Keith Jackson, you remember a common phrase that he would say during performances and things. He would say, "Whoa, Nelly." And if you're looking at these numbers and you're looking at things, you're thinking, "Well, whoa, Nelly, this has been a really bumpy month. What's going on here?" Well, let's get into that. But first, I need to share with you these disclosures. There will be a quiz at the end of today's program, so make sure you memorize them fully. And let's get into some of the things we wanted to visit about today. So March, April, and really the May are typically months in which you see volatility, especially in March. And March was a big spike in volatility. It's one of the highest seasonal times of volatility in the S&P 500 is the month of March. We usually see that decline in the months of April, and I'm going to show you some examples here in just a moment. But we expected March to be volatile without a war or a national or international conflict. So what I wanted to kind of show you here is let's put the month of March and this decline into some perspective. So I went back and I looked at a scenario here because technically the NASDAQ is in a correction phase, meaning that from the peak of the market in the NASDAQ to the bottom, which I can't call a bottom yet, but I believe it might have been last Friday, if the trend continues here. But from peak to trough in 2025, the NASDAQ was down about 22%. In fact, that's not a correction. That's officially a bear market. The S&P 500 during that time, and this time period is roughly around the 1st of February through the first week of April, okay? So to give you some comparison. So last year, the S&P was down 17%. NASDAQ was down 22% at its low point. And then for early 2026, now I did these for last Friday. So those numbers I showed you earlier, I can go back to those actually. Wrong way. I can go back to those and you can see the month of March for the S&P was down 5.1%. When I took these readings last Friday, you'll notice that peak to trough it was down about 8%. Still not in correction territory for the S&P 500, but the NASDAQ was slightly in correction territory. Now, let's go back to 2025. What happened from the peak to trough, from the trough in April, early April of 2025? What happened the rest of the year? Well, the S&P finished up from that point positive 37% from that low point in the market. The NASDAQ was up nearly 54% from that low point in the market. As I said, this period of time from March to April is a very volatile time. And we throw in a conflict and you'll see that there's going to be some pullbacks in the market. What I'm saying here is this is not unexpected. Certainly we don't like to see any periods of decline, but it's certainly in this case not unanticipated, okay? So let's add in the component of the Iran war a little bit. Now this chart's a little bit busy, but I've got two charts up here. One is the change in the S&P 500 performance during different geopolitical shocks. And what I have here is several. The Iranian Revolution from 1979, the Ukraine War, which started back in 22, the Arab oil embargo, which was 1974. Some of us that are listening remember those times when gas prices spiked and so forth. And then we've got the Iran War there in the teal blue color there. And then finally on the bottom, you see the Gulf War and its impact back in the early 1990s. So the Gulf War probably had the biggest impact, I think in many ways, because that was probably the first major conflict that we had experienced since Vietnam. And I think there was a lot of jitterness, if you will. But most of these, the Iran War and the Gulf War, all kind of took place, and we saw shocks in the market. Now, on the right is the change in the 10-year Treasury yield. And now this is why we saw bonds decline in the month of March, because interest rates were actually rising. And so you see there, the Iran War is then the teal blue, and it is quite similar, or didn't spike as fast as the Gulf War back in the early 90s. And even Ukraine had a large spike in yields there. And a lot of that has to do with the price of oil and a number of different factors. We're not going to get into those necessarily on this broadcast, but there are a lot of different things that we see that are happening that are somewhat typical. The problem that I have in listening to the pundits, we've got all sorts of pundits that are coming on television to give us their, and I'm using air quotes here, their expert opinion, is how is a military expert also an expert on the markets? And how is the market experts also an expert on military strategies? And a lot of these things are we have to kind of filter through the noise, filter through what people are saying and look at the reality. Politics is politics, and you're going to kind of believe towards a bent of how you typically view politics, whether you're more conservative, a little bit more to the left, or whatever that may be. And that's okay. I'm not here to debate those with you. My job is to filter through those things and try to understand what implications these things might have on your portfolio. And so last night, the president was talking about oil and different oil shocks and things. And he mentioned one thing that I thought was really interesting. And he said this a few times. He said basically that the United States is energy independent. And I think that's at best misleading, that we're self-sufficient. I'll talk about this in just a little bit more, but I wanted to show you the graph on the chart here. And so this is how much, these are two things here, how much oil prices spiked after the invasion of Ukraine by Russia, and then after the U.S. invaded Iran. The situation with Ukraine having to do with transfer of oil to different European countries, the invasion of Iran. Obviously, you've heard a lot about the Strait of Hormuz. I think that the Strait of Hormuz can be opened up, but fairly easily. But I think there's a little bit of a political bent here, which I will not get into it, that it might not be open as quickly as people want. So you can see here the price of oil spiked really high very quickly to $120 a barrel during the invasion of Ukraine. The price of oil prior to the conflict was right about the same price that before the Iranian conflict, about $65 a barrel. And you can see that as of last Friday, oil prices spiked to $101, and it had intraday spikes. Like today, on Thursday, April 2nd, oil opened up supposedly because of President Trump's speech, not giving a clear picture of when the war would end. It caused the oil prices to go up to about $112, $113. I think they're now back down. We're going to see this intraday fluctuation and volatility, but very similar and less dramatic on both the stock market and oil prices compared to the different various conflicts. So let's talk about why I think it's misleading to say that we are energy independent. The reality is we import millions of barrels of oil a day. Our production in the U.S. is primarily light crude, and we produce a lot of it. It's from fracking and things of that nature. I'm thinking of our clients in West Texas right now that are in the oil fields today. The medium and heavy density oil is what we import to our refineries to process for gasoline. So we had a client the other day ask questions like, why is gas going up if we're energy independent? And the reality is the type of crude oil that we use to refine into gas, because of the age of our refineries and things of that nature, that the way they're built, and because in some states certain influences won't allow new refineries to be built, we're primarily importing the more medium and heavy density oil to produce gasoline in our domestic refineries. So while in total gross, yes, we are a net exporter of crude oil, it's the type of crude that we use is important. And then you tack on to what's going on in the Middle East. Well, and producers cut production in the Middle East because They don't have enough storage space. They can't keep producing oil if they can't get it out of the Middle East through the Strait of Hormuz. And so prices have naturally spiked relative to demand. And the U.S. is typically impacted by this because of the mismatch that we have in the type of crude oil we use to produce gasoline. So this is going to continue to be a problem. I think it will be a temporary spike in the price of oil, price of gasoline. And I think as soon as the Strait of Hormuz is opened back up, or at least there's a plan to defend the ships that come through the strait, that will have that resolved and gas prices will drop again. But until then, it's just a simple supply and demand. There is not enough supply for the demand that we need across the world. But it is very much not a U.S. problem. It's a global problem. And that's how oil prices are priced, is globally. Let's look a little bit here, kind of summarize some of those points. This is the price of oil going back and forth through different conflicts, the Ukraine war, the Iran war, and the Gulf War. So the Strait of Hormuz here is a little bit different than the Ukraine war. That is a key checkpoint. It's only about 24 miles wide, and there's only two shipping lanes that can pull ships through. The oil spike is fairly similar that we've seen in past wars, but not quite as high as we saw in the Gulf War or the Ukraine war. And so the market reaction to all this stuff been kind of normal, what you would expect when there's a big conflict. But you've also got the normal volatility in the market this time of year. And the stocks, yes, they are volatile, but they're not extremely abnormal in any way. We talked about the yields just a few slides ago. The rising yields are showing some concern about inflation. And in fact, we'll have a slide here on the Fed update in just a minute. But this puts more constraints on the Federal Reserve. We're already using strategic reserves, and the president opened up this strategic reserves for us to put that into the global market to try to keep oil prices down. The previous president did the same thing, not during a war, but just to keep prices in check. And then, we're going to see this continued volatility, and eventually we'll have stabilization. I heard some of the pundits last night after the president gave his speech. It's like, well, we need to know when this war is going to end. And I think that's an incorrect way to look at a military conflict. You don't want the enemy knowing what's going on. Now, whether you believe you're for the troops or not for the troops, I hope you're for America. But, that's just a pattern that we're going to look at here. You can't tell the enemy when you're going to stop because that gives the enemy resolve just to outlast you. And so we look at that. I don't think we're going to ever get an announcement that this conflict is over or will be over in a future date until the objectives have been met. This last month in March, the Fed didn't move any rates. And so they left it unchanged. They acknowledged the Middle East risk. There still was one Fed president that pushed for cuts, but in the last meeting in January, there were 2 or 3 that pushed for cuts. So I think that what's going to happen here is the Fed is going to wait and see. They don't really have strong conviction either way. There was even more of a hint that they might even have to raise rates should oil prices stay stagnant or at the higher levels. And it's always been our belief that for inflation, it's not the oil situation, although that can impact it. It's really the money supply. That is a better long-term inflation signal. What we saw in 21, 22 with some of the bills that were passed was that we were pumping trillions of dollars into the economy. That's what really caused the inflation spike that we saw. So we'll wait and see. We'll update you on the next Fed meeting when it's time. Let's look at the Treasury yield. We can still see that normalized curve on the far end. You've got Treasuries that the 30-year that are out there between 4.8 and 5%. And then the 10-year Treasuries are much lower. They have been rising just a little bit since the Iran conflict. So you may see things like mortgage rates and things of that nature continue to trickle up just a little bit. But for a time in late February, early March, we were seeing mortgage rates that were below 6 for a 30-year conventional mortgage. So that's good news. That's overall trending in the lower position. The consumer price index. So this is the measure of inflation. We only have February data. That's one of the disadvantages of doing our market update early in the month is sometimes we don't have all the data from the previous month yet. And inflation remains stable. I do not agree with the president saying that inflation is gone. I don't know how he's able to say that with a straight face, but then again, I never have understood how most politicians say anything with a straight face. So core inflation held steady in February. The key drivers in February were energy. And of course, that's going to show in the next print of the consumer price index is going to show energy prices going up quite a bit. The thing that I really worry about just a little bit, especially if you're a farmer, is the price of fertilizer and things. This is the time of year that farmers are putting that out, and I have a feeling that it's going up very rapidly. But we'll have to see what's happening in the next report there. So anyway, rate cuts, because the inflation is kind of in check, it's remaining stable, we're probably not going to see any rate cuts anytime soon. So when you look at this 2.4% year over year, that's still above the Fed's targeted mandate, right? 2%. That's the Fed's targeted that they want to try to stay around. But it's not far off. So it's unlikely that the Federal Reserve will take big steps to cut interest rates quickly. Now, remember, we're going to have a new Fed chairman likely in the month of May. And it's interesting because current Fed chairman Jerome Powell sounds as if he's not going anywhere. He's going to stay on as a regional president. We'll have to see how that pans out. Producer price indexes. This was a little bit of an upside. It was hotter than expected. There was a broad-based increase, but not just in one category. Same thing here. The key drivers were energy and food prices. Although today I did hear that finally the price of eggs are at their lowest point in 4 years. Hooray. I get mine from the farm. But for those of that had to go to the grocery store, I guess that's good news. That's kind of was the big story, if you will, during the campaigns and so forth, is the price of eggs. So they are at their lowest point in roughly 4 or 5 years. So, we're still seeing the cost of producing the goods that you consume kind of going up. So it's going to be interesting to see what that impact is with the March data when it comes out. Employment report. I doubt we'll see a new employment report until next week. But for February, we actually had a pretty big softening in the market for employees. Jobs were down 92,000 jobs in February. That was well below the expectations. Now, they also revised previous jobs reports down as well. So there's a net loss of 161,000 jobs. The private sector is weakening a little bit. This is not signaling a recession. What it is saying is, hey, things are slowing down. The things that I'm watching right now, this morning, the unemployment initial claims report came out for March, and it was actually at 202,000. First-time claims actually dropped a little bit from the previous month. But I'm also seeing a number of large employers. I think Oracle was the latest in the last day or two that announced some major layoffs. So this is all going to be kind of absorbed over the next few months to see how that impacts the overall strength of the economy. Consumer confidence is still pretty high, but you're seeing some cuts and layoffs and more people looking for work. So I would expect that we're going to have a little bit softer job growth ahead, especially in the coming months. Okay, retail sales for February. So what you see here is the headline strength and some still continued underlying softness. Retail sales rose at 0.6 for the month of February, and that's the best we've seen of a retail sales increase since July, and it beat expectations. But the broader trend still shows some weakness. Now, a lot of the gain in February is because of the bounce back from the bad weather that we had in January, but momentum is slowing a little bit. If you look at the sales are up 3.7% year over year, but when you go back and look at the past 6 months, that number, if you annualize it, is only about 1.8%. So some softening in retail sales, but you've got to be careful, and we just watch those things there. I don't see people that are slowing down purchases, but consumer sentiment kind of remains about where it is, somewhat strong. I think enthusiasm is a little bit different than actually going out and buying those things. So we'll have to keep an eye on that. Personal income and consumption, we only have the January data here with that. They were both up about 0.4%. And that's good because we want to see income growth to be pretty solid here. It's healthier income source. That's always positive when we see workers making a little bit more money. Government transfers, though, are rising a little bit faster, and those are less sustainable. When we talk about government transfer, we're talking about welfare payments and things of that nature. Spending here, we are a service economy, and that spending really was driven by services, not goods. So we're not buying as many cars, but we are buying a lot of services. And inflation's really driving a fair amount of that spending increase. So real spending, if we had to look at that, it's basically flat. So the takeaway here is consumer strength is still intact, but under some pressure. And then going forward, we'll have to see how things like geopolitics, oil, weaker jobs reports, and things of that nature, how that impacts our spending as a country. Existing home sales were up 1.7%. It's a little bit of a rebound from January because of all the weather, but it's still historically considered low. We're still below those pre-COVID norms. As I said earlier, mortgage rates improved. So that means a little bit better affordability. We look at this from the standpoint of affordability. What's the average house price in a given market relative to the average income, and is that affordability improving? When interest rates drop, affordability does improve. Prices remain kind of flat. So if you're thinking about selling your house, expect that you're not going to get the eye-popping prices that you had a few years ago. We still had this lock-in effect because people, I mean, if you've got a 2.8% mortgage, it's really hard to let go of that. And maybe you don't want to move to go pick up a 6% mortgage. So a lot of the competition is between new home builders and things because people are hanging on to their existing houses if they can. And I expect, we'll see some gradual improvement in 2026. So we'll keep an eye on that. New home sales. This is still January data. They tend to lag a little bit for their data and so forth. January was weak because of the weather and the ice storms that we had across the country. We still see for new home sales, people are competing on price. Builders are offering lots of incentives to move that inventory. So if you're in the market for a new home, and maybe that's the way that you want to go because there's not enough inventory amongst existing homes, that might be a good time to look at some of the new home builders because they are offering some pretty good incentives. I expect we'll see a modest rebound in 2026 if things end quickly with the Iran conflict. Excuse me. Durable goods still flat, showing some softness. Our thought is that growth is going to be slow this year. The economy is expanding still, maybe at a 2.2% rate annualized. I think we're going to see softer job growth, especially with a lot of layoffs that are coming. And, there's lots of distortions out there, geopolitical risks, oil prices going up. All those things impact our economy and how that's doing. So the economy is not really booming, but it's also not contracting. So I don't foresee a recession anytime soon. Although the last example that we have to look at is when Russia invaded Ukraine. Oil prices spiked, and they stayed up there for a while. And that extended oil price increase really drug on the economy. There was all sorts of other things going on as well. We had exploding inflation, and so even though the government said we were not in a recession at that time, we technically were. We can have another conversation about how the government determines whether we're in a recession or not. I don't see that coming, but we'll have to watch it closely to make sure that things are not changing in such a way that might risk a potential recession. We've already talked about oil risk enough. I think that conflict that is the wild card. Okay, and the Strait of Hormuz, that is a critical supply choke point. And yes, the government, the military going into this conflict had considered that. And I've seen lots of stories where the U.S. government didn't consider that Strait of Hormuz. Believe me, they did. And so, we want to keep an eye on that geopolitical potential shock. And that could be, something that causes high oil prices for a while. But an oil shock is not going to drive inflation as much as people think. And I think the Fed will probably continue to pause rates, but not react aggressively. That's not their nature to have a spontaneous reaction. I think the big risk here with going forward in the next couple of months is volatility more than a recession risk. So we're going to continue to see these ups and downs. And once that's settled, I think the market will return to its highs. So what's the impact on all this? Remember, you can text us at 254-282-0495. And I wanted to see if there's any questions on the board. Doesn't look like there's any. But if you need someone to talk to you about your portfolio, give us a call. We'll be glad to talk to you and walk you through that. A lot of times it just takes a little bit of a conversation to calm us down a little bit and realize that we can just keep going forward with our plan. But you should be talking to your advisor right now because you want to make sure that you're in check, your financial plan's on track. As I always say, don't panic. Stay focused on your long-term goals, not the headlines. The headlines are awful. I don't even read them now. If I see an article that's interesting or is about a topic that I want to review, I'll skip the headline, go straight to the data, and then I'll go look at another source to get their information, their data, because everything, even the Fox News channel who says they're fair and unbiased, are biased. Everybody's biased. And, watch the news you want to watch, but know that we are viewing that through the lens of the politics of that particular channel or whatever. So, stay informed. Give us a call anytime. You may be asking questions about your retirement. If you're still working and you have a 401k, you need to take a look at it. A lot of 401k plans are changing. One thing I'll mention here is that they're giving access, and a lot of the 401k plans out there giving access to private capital, credit markets and things. Be careful. Make sure you talk to your advisor before you do anything. Do not call the 401k plan provider and ask their opinion, because some of these things are very dangerous and investors don't realize what they're getting into. So if you see that come up in your 401k plan menu, give us a call. We can also give you guidance on your 401k plan. We have a tool that we use to help you rebalance when things are maybe out of whack or you need to get back on track. We just had a rebalance here about 2 weeks ago. So we're happy to enroll you in that. Even if you're not a client, we'll tell you how to get access to those things. As always, check your statements, talk to a professional, educate yourself from many different sources. Don't go to ChatGPT, because as I was preparing for this broadcast today, I went and just to check my math on a couple of different things like the market performance and things. I asked ChatGPT and they gave me completely different answers that were so far off. I typed back into the bot there and said, "You are so far off that I can't even count on you to give me accurate answers." And of course, the chat bot apologized and did a little more research. They still didn't get it right after the extra research. So anyway, As always, if you have questions, give us a call. You can call us at 254-282 or text us. Our main line where Carla will answer the phone for you is 800-491-4580. Or you can visit us on our website at clearvistafinancial.com. And hey, let's check out our website. We've got lots of educational videos there, lots of articles and things you can read. We're trying to update those on a consistent basis so that you can keep apprised of what's happening in the markets. Until next time, our next update will be May 7th at 10 a.m. And we will talk to you then, if not before. Have a wonderful Easter weekend, and we thank you for listening to our show. Have a great day.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.